Well, folks, the opportunity to go shopping continues to hang out here. It is quite incredible, the market that we're facing right now. A lot of talk about put options in this market, and I usually love when more and more discussions come up about shorting or people selling, because sometimes it can almost indicate a little bit of an approach to a bottom, especially when you have more and more questions or commentary that comes up about, oh, I'm going to take somebody says, for example, I'm going to take a 20% loss on something. That's it. I'm just going to hang out on the sidelines. Sometimes these can be the perfect opportunities to signal, okay, maybe that means it's potentially time to buy. Now, something that was misunderstood from earlier this morning, there were some comments about this, and it was complete. Sometimes I think people just are looking for things to hate on because they're unwilling to respect uh, live commentary. This morning, I was talking about how around September or December 16th, we had written these floors, and what those were test indicators. They weren't actual floors because we knew there was a chance they could go lower. So we had written these test indicators as a sign of, hey, if Lemonade goes under 40 or DocuSign goes under 140, SoFi breaks 14, those were red flags to us. Those were actually red flags that would indicate, okay, this market is actually not able to hold on to anything. And it was a red flag that the market could actually continue to fall further. And we broke a lot of these sort of temporary little scaffolds, we'll call them, rather than floors. A lot of those were broken by about the first week of January, which what's scary about that is it kind of set up the market to keep falling. So in my opinion, those were really a leading indicator for more pain coming in the market. And I think they'll also be an indicator for our eventual rotation back out once we start breaking those prices to the upside again. Though it'll probably be a while, just because the market is so sensitive, and in my opinion, quite over responding to this fear of a Federal Reserve tightening cycle. I think that's because the narrative has been spun for too long that the Federal Reserve has propped up the stock market, which to some degree it has. But what we're seeing now is just an egregious overselling. But that can beget opportunities, and those are the sorts of opportunities we see. We were talking a lot about different strategies for hedging in the live stream this morning. Put options, balanced way to potentially look at puts, pricing out where there might be better deals versus worse deals. So if you haven't yet caught up on the course member live stream, you could always watch that after this live, play it back on 2x, and you'll get caught up. So take a look at some movers today. Interestingly, you've got some big momentum movement in DWAC today. And you can often get this out of simply pure momentum, that when the entire broader market is selling off, you see DWAC, for example, this morning up 3-4%, and this herd mentality of squeezing something like DWAC up even more. It is honestly a large irony that companies with true value, whether that's in the fintech space or in the energy space, in the solar space, or the electric vehicle space, or the banking space, whatever, companies with true value, actual book value, and real products can sell down as much as they're selling down today. Cybersecurity firms with yes, higher valuations, but phenomenal investments into the future growth of their companies. These sorts of companies can sell down anywhere between 3 to 10% today. And then you've got something like DWAC just to punch you in the face and go, bah, but this one's up 25%. It's kind of funny, kind of comical, and I think a potential danger is letting that skew an investing outlook. Now, still wanting to stay away from a lot of the small caps that are really having trouble breaking out of some of these pain cycles. And this is why even something like SoFi continues to rotate down. I mean, look at this. SoFi now down at 7.7% to the downside. It's sitting at just $12.18. I mean, an incredible amount of pain over in the fintech space. Fintech, trading revenues, everything's just going into the toilet, getting substantially worse at the moment, sadly. Smile Direct is going to break $2 here. I wonder if we are actually already broken $2. Let's take a look here. No, not quite yet. $2.02 is where Smile Direct has rotated down to. You've got EXPI. Look at this, folks. 7.19% of the downside. Lucid down 7%. I mean, a lot of broad-based pain here. Lemonade, Dave & Buster's. Doesn't matter if it's recovery. Doesn't matter if it's a small cap. Doesn't matter if it's cybersecurity. It's everything's down now. Somewhere between 4 and 8%. A lot of pain. Again, more and more broad-based selling. There doesn't. This is something important to remember, is there does not have to be a short-term end to this morning in the course member live, which, if you're interested, by the way, in these extra sort of lectures on how to behave in sort of this sort of market, do consider the links down below for the programs on building your wealth. There's a coupon code that does expire on my birthday, which is coming up in now 10 days, which is super exciting. Path course will also be released by the end of the month, which is super exciting. But anyway, yeah, you've got this broad-based substantial pain. And certainly the shorter-term put contracts are the ones winning right now, similar to what we talked about this morning. But the opportunity for shopping, in my opinion, has not been this good in a very, very long time compared to what we've seen really over the last couple of years. I mean, let's just pick a few choice stocks here and compare to what we've seen really over the last couple of years. So, for example, let's go with Sunrun. Let's compare Sunrun. How long has it been since we've had these prices? So Sunrun at $29.20 has not seen these prices since, folks, the summer of 2020. That's incredible. In fact, I'm going to make a little list here, and I'm going to say summer 2020 and prior. Okay, that's what we're going to look for. So it's almost like potentially creating a basket of summer 2020 and prior. And so that's going to be Sunrun. So I'm just going to write down run. Run, like run away from the market. Then we've got, let's see here. Thanks. Thank you. Next. Yeah, let's look briefly at Diz as well. Some stay-at-home activity could be in Diz thanks to their streaming service. Now, we saw this low pricing at the end of November, but otherwise, we're really more towards the winter of 2020. Roku, on the other hand, though, at 164, we're at summer of 2020 pricing on Roku. So let's write down Roku. I believe that also means we're going to see ARK sitting at the summer of 2020. Take a peek. That's AR. Let's try again. ARK. ARK pricing is summer of 2020. Wow. Look at how we are evaporating gains of essentially the last couple of years on some of these companies. Really, really mind-blowing. So we go back on DraftKings. We're going to go back here to, look at that, folks, the summer of 2020. DKNG. All right. NVIDIA should be nowhere near the summer of 2020. Oh, yeah, no. NVIDIA has just done phenomenally. Carnival Cruise Lines from some of its levels here. Let's look at NEO. NEO is really sitting around October of 2020 pricing. So I can't really say summer on this one. How about Beyond Meat? That should be... Whoa! Beyond Meat is actually relatively close to spring of 2020 pricing. Oh my gosh. Let's write that down. Beyond. Wow, that's wild. Boeing. Ooh, that's a good question. Let's see how Boeing is. Yeah, we could basically look at Cathie Wood stocks. Boeing's doing fine. What are some other Cathie Wood stocks? Let's go TDOC here. TDOC 75 brings you right back to... Oh, golly. Yeah, absolutely prior to summer of 2020. So TDOC getting smoked. Let's try Zoom. Zoom video, 158. Definitely still up over the past few years here, but probably, yep, brings us back to about the summer of 2020. Wow. ZM. Another Cathie Wood stock. How about Domino's? Domino's should be up since then substantially. Oh, yeah, okay. So, yeah, 465. Domino's up. We know Tesla's up. Chipotle. How's Chipotle been doing? Chipotle was summer of 2020 was sitting more around $1,100, so that one's okay. Let's see. First Solar, it's a Canadian company, $80. Yeah, we could roughly throw them in. FSLR. FSLR. How about Enphase? Enphase is up nicely since summer of 2020. So is Restoration Hardware, JP Morgan. How about Snap? Let's look at Snap. Snap has brought us back to about the election time frame of 2020. Trade Desk still up nicely. Palantir wasn't public then. When did Palantir go public? Yeah, okay, roughly about the summer of 2020. But it was it's not lower than what it was then. What else? We got a good little list here. Dropbox, $24. I've never really wanted to buy Dropbox. Yeah, I mean it's actually not lower than what we had then. Dick's Sporting Goods, Tattooed Chef, Fix. Well, the Tattooed Chef went public via SPAC after. Etsy's over. It's an interesting list that we actually have. Let's look at Win. So Win's at about 90. And you could really see in the summer, it was at about a $69 level very, very frequently for Win. Let's do maybe a few more, and then we'll go see what other coverage we have. So Target's way up. Target's on great. Nike, let's take a quick peek at Nike here. 146. Nope, still doing good. Adobe should be doing fine as well, despite the sell-off here. 455. Actually, we're kind of getting there. Kind of rotating back at 550. We're really just evaporating the last couple years of gains in the stock market and just revisiting some of the pain that we had really in the summer and spring of 2020. And it sort of begs the question, like, can we go lower than that? I mean, in theory, yes. But just wild to even think about how much time could be eradicated. Let's look at CrowdStrike. PayPal and Visa. Yeah, we'll look at those as well. No, not quite on CrowdStrike. Let's try Visa. Is Amazon back at its summer levels? Let's see here. Visa. Yeah, you know what? Visa's somewhere around there as well. Visa. Let's look at Amazon. Amazon. Okay, we're sitting here at about 31, 36. Yep. Amazon's done virtually nothing. Which is so incredible because it's been such a phenomenal company. JP Morgan, really? Let me see here. JPM for summer of 20. Nope. Summer of 2020, JPM was a lot lower. That's what I thought. Let's look at a firm quickly. Was the firm public then? No, a firm wasn't public then. Very volatile stock. Anyway, that's an incredible mix of companies that have rotated to the downside to essentially summer of 2020 levels. We'll look at maybe a couple more here as they come up. Autodesk, and then we'll get into the news. Square. Let's look at Square and PayPal. Oh yeah, Square's there, and let's try PayPal. Yep, Square and PayPal. Square, PayPal. How about DocuSign? DocuSign 125. Yep. Docu. Jeez. How about Salesforce? 225. Yeah. I mean, August is 225. That's technically summer. So I'll put down CRM. The Biden stock refund. That's a good. That's funny, dude. Oh, that's bad, but also funny. Let's go back to the summer of 2020 before Biden was elected. Oh, well, yeah. I mean, according to this list, that's approximately the timing. How about Ubiquity? How's Ubiquity been holding up? UI 287. It's actually not been doing that bad if you think about it. It's really held on to that 300 level, just rubber banding around it. Quite incredible. I mean, it's done a lot better than some of the others. How about S-Edge in the solar space? The last one I'm gonna look at. But really, what a giant reset. Yeah. 225, 239. Not quite summer, so I can't really throw this one down. Close though. Golly, that's quite painful. And then, of course, you have a lot of SPACs, whether that's Matterport or Lucid or recent IPOs like Roblox or Robinhood or whatever. These, of course, not anytime weren't around in the summer of 2022. Or, sorry, summer of 2020. But I'll just recap that list really quick. Run, Roku, ArcK, DraftKings, Beyond Meat, T-Docs, Zoom, First Solar, Visa, Amazon, Square, PayPal, DocuSign, Salesforce, all back to summer of 2022 pricing or prior. Wow, wow, wow. Pain. Let's take a look at Tesla. Wow, Tesla was green earlier today and is now back to 2% to the downside. Let's take a look at that day. Oh, yeah, look at that nice drawdown here into the close. Looks like your best deals might be here towards the end of the day again, as we get a potential sell-off into the close. Backed holdings actually trying to rotate up a little bit into the close. That usually only happens if BTC is moving up. No, not really seeing that. How about DWAC? DWAC holding on nicely, and you've actually got Tattooed Chef up about 3% here. Activision, of course, on merger news or acquisition news, rather, not so much merger. And all right, let's go ahead and take a look at what we've got for yields and what else is going on. Okay. That is not what I'm expecting. There we go. Let's see what the headliners are. Why is this not loading? You know, it must be hard for a Mac to run CNBC with how red everything is. So it just dies. Yeah, there we go. Oh, I ruined it. Clicked it too fast. All right, so look at that. Russell 2000 leading losses down about 2.5. No, I'm sorry. Actually, technology is down 2.5%. Russell right behind at 2.48%. S&P down 1.86. Woo. Dow's down about 1.56. Bonds. The 10. I think the 10 years probably honestly going to run to 2% pretty quickly, and maybe once it runs to 2%, we end up getting a little bit of a slowdown, and the drama of pricing in these higher rates starts U-turning. But for the time being, we could continue to see quite a bit of pain, and I think that's exactly what we're seeing here. So a 10-year bond at 1.873. My goodness. The 2-year is now at 1.045. Wow. I'm going to go try to grab quickly the curve between the two. Yeah, that'll just take a second to grab. So I guess we can listen to Anastasia for a second if we wanted to in the meantime. Let's do that for a second here.
But it's the high-flying tech shares that needed to correct. And when I look at price to sales ratio for some of those really high-flying, high-multiple tech shares, they already see those multiples come in some cases, 50% or so. So I do think that what's starting to emerge is a better level of what's priced in. But again, we need to have a positive catalyst emerge here. And so far, the Fed has been hawkish, and it's let the market extrapolate even maybe more hawkishness. And until they change that, I think we could see some volatility here.
Not getting a positive catalyst from the banks today. Goldman Sachs, the latest to report. It's the biggest drag on the Dow, down 7%.
Well, okay. Let's see here. 10-year, 2-year. I have no idea where my terminal key is. Oh, there it is. I was looking for the darn thing and I found it. Okay, no worries. We can get the 10-year minus the 2-year from another source, though. So that way we save some time. What we're looking for to see is just the spread between the 10 and the 2, and we can do that here. Looks like the last date we actually have is Jan 3rd. I want to get a little bit more of a recent date, though, of the spread between the 10 and the 2. So 1 sec, and we'll go ahead and pull that up. The more we flatten, the more fearful markets get about a potential for a recession. But another thing that you can look at too is how inflation expectations are rotating. And we can look at those by looking at the 10-year break-evens or even the 5-year break-evens. And so we'll look at those in just a sec. Okay, here we go. And we got about 8 minutes to go until the market closes. Okay, so let's just do a quick Google together here while this loads. Let's go for 5-year break even. See if Y Charts is updated to today. So today we are, that's Jan 12. Yeah, see, not getting the most up-to-date info on both St. Louis Fred and Y Charts. No problem, I'll get them from the back end. Okay, 5-year break even. 5-year. Now that it's up. 5-year break even. And this will really show us some inflation expectations. And so we could see, is this pressure really just coming because of Fed tightening, or is it really because the bond market's pricing in inflation fears? And the answer right now appears to be that the 5-year break even isn't actually really rotating up that much. If I go back over the last 6 months, yeah, that's crazy. Okay, stand by. Here we go. Okay, so shout out to Bloomberg for the chart, but take a look at this. This is September over, this is September over here. And so we had peak inflationary fears right here coming out of Delta. You can really see Delta pushed your inflationary concerns up here. But despite these yields skyrocketing right now, we're not actually seeing the break-even rates rotate up, which is a sign that that inflation isn't really driving the fear that we're seeing in this market. It's potentially also a signal that the markets are just overreacting to Federal Reserve behavior. But by no means are we not seeing pain in the market. We definitely are. See how things are going into the close. But that to me is always something worth paying attention to, is while yields are rising, if anything, they're almost rising in this parabolic manner right now. How are other things reacting in the market that would generally react negatively, like the break-evens? And we're actually not seeing break-evens move at all. And that's weird. Let me just confirm that we have that updated pricing as of today. Yeah, we do. January 18th. Virtually no movement on the break-evens. Break-evens, by the way, is taking the yield and subtracting tips. And the difference, since tips have generally been negative, the difference is your break-even rate. And generally, the more inflation fears we get, the higher the break-even rate goes, which, again, we haven't really seen. Okay, let's see. So Cardano really giving up a lot of its enthusiasm right now after some of the hype cycle that we saw over the weekend. Looks like Microvision, wow, it's under $3.50 for Microvision. That is just incredible. Nikola under $9.22. Folks, SoFi is almost under $12. SoFi just bounced at 12.03. I mean, you've got oil going up, you've got bond yields going up, you've got more fear in the stock market, leading to more fear and more selling. Yet the reality is inflation fears aren't actually going up. And so underlying, the market's actually quite strong. Well, maybe not the market, but the economy. Less inflationary fear, potentially slightened weakened GDP, but still GDP growth from Omicron, hoping that Omicron comes to an end and that Omicron becomes endemic. But boy, oh boy, what a sell-off here from markets. So, and this is certainly that kind of market where when you buy the dip, it just feels like you're putting money into a fire pit. And then that is what it often feels like in what oftentimes turns out to be some of the best times to buy. It's just difficult to time that perfectly. You could get close though. And that's always the best case scenario, is that when markets are feeling euphoric, you're holding on to your cash, right? These are the things that we talk about daily in the Stocks and Psychology of Money course member live streams we do. When times are euphoric, we hold cash. We don't buy, sell. We take profits on options and wait and be patient. And now are the opportunities to exercise that patience, in my opinion. It's always times when the markets are rotating down that all the haters come out in the comments and like, oh yeah, good job buying the dip, it just keeps dipping. And these are folks that generally sit on the sidelines regularly betting against America, buying gold or buying or nothing, sitting on the sidelines because they're too fearful. And then all of a sudden the market runs again and it's, whoa, markets are euphoric. It's always the sad bears. Ooh. But that's okay. Bill Ackman, another thing that was very interesting, I saw Bill Ackman coming out about, he had something negative to say again. And as soon as Bill Ackman starts talking negatively, I think the guy is shorting the crap out of the market again. I don't believe this guy at all. I think he's a total deception sales player. Yeah, look at this guy here. Okay. He's the same guy that back in March of 2020 was pooping on the market. Meanwhile, he was shorting the crap out of the market, going on TV about how horrible the market is, how bad everything is. And then meanwhile, he closes his shorts and buys the dip at the bottom of the market. And here he is, Mr. D-Bag himself. Bill Ackman says the Federal Reserve needs shock and awe rate hike in order to restore its credibility. The guy's a shyster. Federal Reserve needs shock and awe in a series of tweets on Jan 15th. The Federal Reserve could work to restore its credibility with an initial 50 basis point. That's a surprise move. Dude, this guy is shorting the crap out of the market. He's a scumbag. I would place money on this guy shorting the crap out of the market right now. Oh my gosh. Ackman said the Fed is losing the battle against inflation, highest level in 40 years. I mean, now you're just regurgitating generic talking points. You look at the break evens, and this is not actually what's happening. Central bank, painful economic consequences, blah, blah, blah. I would love to see this guy short positions. But when he's coming out bagging on the market, that's a buy signal, in my opinion. That's crazy. I didn't know he was that ridiculous about it. Whew. And sure enough, the markets are experiencing this similar kind of pain, with the exception of certain things, that we saw in about March of 2020. The only thing missing right now are those circuit breakers. Who remembers those? When the indices were going down like 7% and everything was on fire. It was terrible. And it was really, really a time of drastic fear, continuous sell down. I mean, really, really quite incredible. Anyway, let's take a look at the closing bell. Here we go.
Financials, of course, suffering significantly. Goldman down 7%, Morgan Stanley down 5%, despite not having reported earnings yet. A false start there for Ring the Bell and a false start to the trading week, no doubt about it. Sharp declines on Wall Street today, down 1.8% on the S&P 500.
Another ugly.
And there we go. Dow Jones down 1.51%, S&P down 1.83%, NASDAQ down 2.6%. Russell, folks, down 3.06%. Look at that. It's almost like it crashed into the close there, flying past the NASDAQ. Woo! Lots of pain, lots of selling into the close. In fact, let's go ahead and look at just the pain going into the close here. Looks like we've got a little bit of drawdown here in the S&P 500 into the close, grabbing Tesla here, also pain into the close. You've got the same sort of selling in many of the tech stocks, and really it's not limited to just fintechs like SoFi or Hood. It's not just limited to these. It's broad based. Apple, Tesla, all these guys moving to the downside. Apple's still at honestly phenomenal levels. 169 is still a great place. It's really become almost like a safety play, a play to go where, worst case scenario, it's down a couple percent, big deal. It's nothing like some of the smaller cap plays that have just been getting burned. Even Tesla rotating down today, but nothing compared to the smaller companies, which are the short targets or any of those that are at lows that we haven't seen since the summer of 2020 or prior. Quite incredible. Very, very incredible. And crazy market. So usually on Mondays, we don't have... Oh, wait, it's Tuesday. Oh, we actually might have earnings today. I thought it was Monday. Hold on a second here. Let's see what we've got for earnings today. Yeah, good call. Let's see who reports today. Interactive brokers. No, not much today. Not much that reports today. It's still a little early in the earnings season. Tomorrow. Hold on here. Let's just make sure I'm looking at after the market. Yeah, I am. No, not much today. Tomorrow after, we've got United Airlines. Thursday after the market close, Netflix. That'll be a good one looking into the consumers. Yeah, and next week is really when we go crazy with earnings. We'll only have a few earnings this week. A lot of folks really thinking about hoping that technology companies will get bailed out by strong earnings. I think that's quite enthusiastic. We did have Goldman Sachs this morning, but the banks usually report pre-market, and we did have Goldman Sachs with a substantial decline in sales and trading revenue, and expecting potentially some of that drama to come on over to tech. We'll see. But yeah, PNC, Charles Schwab, Goldman reported this morning. So, okay, folks. Well, it's going to be an interesting earnings season. We'll buckle up for it. But anyway, thanks so much for being here. We'll see y'all in the next one. Check out the programs linked down below on Building Your Wealth. You get to join on those private live streams, see exactly where my head is at my portfolio. And folks, we'll see you in the next one. Thanks so much. Bye.